When you've been in the market long enough, you start to notice that the real money isn't always made when prices are racing higher or collapsing lower. No, most of the time the tape drags itself sideways, inching up and down like a tired mule. And yet, those are the very stretches that break most traders, not because they're dramatic, but because they grind a man down slowly. That's what I want to talk with you about today, how to trade sideways markets like a professional. And yes, it fits right after the previous video on spot breakouts before they explode, because the truth is every breakout first lives inside a sideways market. Now let me ask you, have you ever sat in front of your screen, staring at a chart that moves nowhere, waiting for it to do something, anything, just so you can feel alive again? That's the trap of the sideways market. You think you're missing something, but really it's the market that's missing direction. And the worst mistake is to force trades in that kind of tape. The market doesn't care how bored you are. It doesn't care how badly you want action. It only cares about separating the weak from their capital. A man must first accept that sideways markets are part of the trading life. They're not detours, they're the road itself. If you can't endure them, you'll never last long enough to catch the real moves. So the professional isn't just a hunter of breakouts, or a chaser of trends. He's a patient farmer waiting for his crop to ripen. You don't pull the fruit off the branch before it's ready, do you? Then why tug at a stock that hasn't chosen its direction yet? But here's the thing, sideways markets are not empty. They speak, if you know how to listen. The tape always tells the truth. Those quiet stretches are where supply and demand wrestle in silence. One side is pressing, the other is resisting. The public sees boredom. The professional sees preparation. Which one are you? Do you see how dangerous it is to treat that sideways chop as background noise? That's when you get nicked 100 times, trading every wiggle, thinking you're clever. I did it myself in my early years, nickel here, dime there, until the whole roll was gone. The commissions will kill you, and worse, the bad habits will kill you faster. You begin to think you're playing a game of prediction, when in fact you're just playing yourself. The trick, my friend, is to treat sideways markets as the testing ground of your discipline. This is where the professional separates himself from the amateur. Most men are impatient. They want the market to act on their schedule. But the market has its own time, its own tempo. If you can't match it, you don't deserve to profit from it. Ask yourself, are you really waiting for the right setup, or are you just looking for excitement? Patience is a position too. That's something most people never learn. They think flat means they're out of the game. But being flat is the strongest position you can take when the market offers nothing. You preserve capital. You preserve mental clarity. You preserve the ability to strike when the opportunity finally appears. There's nothing weak about not trading. There's strength in holding fire. Can you see that? Now, some men will argue that money has to work all the time. They think cash in the account is wasted capital. That's a fallacy. Cash is a position, just as much as being long or short. It gives you flexibility, and more importantly, it keeps you alive. In a sideways market, survival is the name of the game. You survive until the big swing comes. And believe me, it always comes. Markets don't drift forever. They coil, they tighten, and then they break. You see, sideways action is the incubation chamber of every major move. If you think back to what we discussed about spotting breakouts before they explode, you'll remember that the buildup always looks like nothing at first. The stock moves in a range, back and forth like it's asleep. But underneath, the forces are shifting. Smart money accumulates. Weak hands get shaken out. The tape grows quieter. That's when you know something is brewing. Do you feel how these pieces fit together? The professional doesn't just wait. He studies. He observes how volume behaves inside the range. He notes whether the rallies are strong or weak, whether the pullbacks are deep or shallow. Every detail is a clue. You don't guess, you read. You don't predict, you prepare. When the moment comes, you're already positioned in mind, if not in money. And when the breakout finally tears through, you're ready, not surprised. But let me tell you, The greatest wealth in trading isn't only in spotting the moves, it's in learning to protect yourself when there is no move. A fortune saved is a fortune earned. Most men never realize that. They measure success only by the trades they take, not the bad ones they avoid. Yet it's the avoiding that keeps you solvent. Have you ever looked back on a month and realized the best trades were the ones you didn't make? That's no accident. That's professionalism. The sideways market is a mirror. It shows you your own weaknesses, your boredom, your greed, your lack of patience. That's why it destroys so many. They can't stand what it reveals about themselves. But if you use it as training, you'll grow. You'll build the patience to wait, the discipline to hold cash, the sharpness to see when the balance is about to tip. Isn't that the mindset of a professional trader? Now, let me remind you the great campaigns are rare. They don't come every day, or even every week. They come only when the market is ready. Your job is to be ready when they do. That's why sideways markets matter. They're the bridge between the ordinary and the extraordinary. They're the silence before the cannon fire. Only the man who sits through the silence can hear the shot. And another thing, wealth building in the market is not about a single big hit. It's about consistency, about protecting your stake so you can be present for the next big move. If you blow yourself up trading sideways chop, you'll never have the capital to ride the real trends. That's the tragedy of impatience. You destroy your future for the sake of the present. Tell me, is that the way to grow rich? The difference between the professional and the amateur is most clearly revealed in a sideways market. When prices are locked in a narrow range, moving up one day and down the next without direction, the amateur feels compelled to gamble. He cannot resist the urge to make something happen, even when the market is offering nothing. He mistakes activity for opportunity. He wants excitement. He wants proof that he's in the game, so he chases every small flicker on the tape. And what does he get for his trouble? Commissions, small losses, frustration, and above all, bad habits that poison his account when the real move finally comes. The professional, on the other hand, knows better. He recognizes that sideways markets are the market's way of testing him. They're a classroom where the lessons are discipline, patience, and preparation. While the amateur throws chips on every turn of the wheel, the professional is content to sit back and observe. He's not idle, don't mistake it for that. He's studying volume. He's watching how supply and demand push against each other. He's taking mental notes of where buyers step in and where sellers push back. He knows that the range is a battlefield where one side will eventually win, and the breakout that follows will be his signal. Let me ask you, do you believe the market owes you action every day? Do you believe that because you sit in front of the screen, you must have a trade? That belief is the ruin of most traders. A professional treats trading capital as his ammunition. You don't fire bullets at shadows. You conserve them for the moment when the target is clear. The amateur shoots at anything that moves, and by the time the real enemy appears, his gun is empty. Now, why does the amateur gamble in sideways markets? It comes down to two things: impatience and fear of missing out. He can't stand the boredom of watching nothing happen. He feels useless unless he's doing something. He also fears that while he sits still, others are making money, and he will fall behind. So he manufactures trades out of thin air. But the market punishes this mindset. Sideways price action is like a quicksand. The more you struggle, the deeper you sink. The professional has no such fear. He knows the market is endless, opportunities are endless, but his capital is not. Every unnecessary trade is not only a financial loss, but a drain on his mental focus. He saves both. In fact, he treats cash as a position. When he holds cash in a sideways market, he is not out, he is strategically positioned to strike when the right conditions emerge. That's power. The amateur views cash as weakness, as wasted potential, and that flawed mindset forces him into traps. Consider how a sideways market forms. Prices move between two levels, resistance above, support below. The amateur thinks he can scalp the little moves inside that box. He tells himself he'll buy at the bottom, sell at the top, repeat the cycle. In theory, it looks easy, but in practice, the tape never behaves so neatly. The range tightens, breakouts fake, reversals whipsaw. The trader gets chopped into pieces. Have you ever tried that game, only to find your account smaller each time the stock twists against you? That's the trap the professional avoids. The professional uses the range as reconnaissance. He studies how the rallies behave. Are they sharp and fast, or sluggish and weak? He notes whether volume expands on the upswings or on the downswings. He looks for signs of accumulation, steady buying pressure beneath the surface, or signs of distribution, where large interests are unloading stock without letting the price collapse. This quiet preparation is what sets him apart. He doesn't gamble. He gathers evidence. He waits until the balance of evidence tips in one direction. Then, when price breaks out of the range, he knows whether it's likely to be genuine or false. He enters with conviction, while the amateur is either broke from trading the chop or too scared to pull the trigger. Think about it. This way, the amateur spends his energy reacting to every tick, while the professional conserves his energy to act decisively when it matters. Which approach do you think leads to wealth over the long run? Which mindset allows you to catch the big campaigns that change your fortune? Wealth in trading doesn't come from 100 small scalp wins. It comes from a handful of large, well-timed campaigns. Sideways markets are the waiting rooms for those campaigns. Only the professional has the patience to sit in that room without fidgeting. Ask yourself, do you want to be entertained or do you want to be profitable? Too many amateurs confuse the market for a casino. They want the thrill, the rush, the constant hit of action. But the market is not here to entertain you. It is here to take your money if you are careless. Entertainment costs money. Professionalism makes money. Sideways markets reveal which one you are after. Another mistake the amateur makes in ranges is moving his stops too tightly, thinking he's managing risk. But in sideways chop, tight stops only guarantee repeated small losses. The market knows how to shake out weak hands before moving in any direction. The professional avoids this death by 1,000 cuts, by not playing that game at all. He lets the amateurs fight over scraps while he waits for the feast. The professional also understands psychology. He knows that sideways markets wear down the patience of the crowd. The longer prices move in a narrow band, the more traders give up. The more they get frustrated, the more they doubt a big move will ever come. That's exactly when the spring is coiled tightest. Then, when the breakout finally comes, it catches the majority off guard. Only the professional who prepared and waited is ready to ride it. Now let's tie this back to your own wealth building. The amateur thinks of wealth as something created by constant hustle. He believes the more trades he takes, the closer he gets to fortune. But in trading, wealth is built not by constant activity, but by selective precision. It's built by protecting your stake when the market offers nothing, so you can press your advantage when it finally offers something extraordinary. The professional is not in a hurry. He knows that compounding requires survival first. He knows that wealth is not created in a week of chop, but in the handful of campaigns that come once or twice a year. If you squander your stake in sideways noise, how will you have the capital to seize those campaigns? Let me ask you plainly, do you want to be the man who bleeds slowly to death in ranges, or the man who strikes hard when the market tips its hand? The choice comes down to mindset. The amateur gambles in sideways markets because he can't stand the wait. The professional prepares because he understands the wait is part of the job. That's why the amateur is always surprised, and the professional is always ready. The real work of trading sideways markets like a pro is internal. It's not about predicting every tick inside the range. It's about mastering your own impatience. It's about building the mental toughness to sit through the silence without throwing your chips away. The professional treats that silence as an opportunity to sharpen his reading of the tape, to study accumulation and distribution, to prepare his plan. The amateur treats the silence as empty time to be filled with bad trades. And that, right there, is why one survives and the other doesn't. Sideways markets are not dead zones, they're the breeding ground for future trends. That simple line holds more truth than most traders ever realize. When you look at a chart and see prices going nowhere, The natural reaction is to think it's wasted time. Nothing is happening, so why bother watching? That's exactly the mistake amateurs make. They see only dullness, but the professional sees foundation being laid for the next campaign. The market doesn't just leap into great moves out of thin air. It coils, it digests, it prepares. And where does all that preparation take place? In the sideways stretches that most people dismiss. Have you ever wondered why the biggest moves often feel like they come out of nowhere? It's because you weren't paying attention during the quiet build-up. The sideways phase is the market's way of gathering strength. Think of it like a spring being pressed down. The more it's pressed, the more energy it stores, and when it finally releases, it launches with force. That's why consolidations, ranges, and so-called boring markets are actually the breeding ground for the most profitable opportunities. But the public doesn't like waiting. The average trader wants action, wants excitement, wants proof that the market is alive. So when the tape moves sideways, they lose interest. They start chasing something else, some stock that's moving today, some headline that promises immediate action. They abandon the range just when it's about to deliver the goods. The professional, meanwhile, stays alert. He knows that the longer a market builds its base, the bigger the breakout that will follow. He's patient, not because he enjoys waiting, but because he knows waiting is part of the process of extracting real money from the market. Think about any great campaign in history. The tape never simply rockets straight up from the bottom or collapses straight down from the top. It first spends time building a base, testing levels, shaking out weak hands, absorbing supply. That base is the sideways market, and it's critical. Without it, there is no strong trend. You don't build a skyscraper without laying a foundation. The same is true in trading. Every explosive move you've ever admired had its roots in a dull, grinding sideways stretch. Ask yourself this when you see a stock trading in a narrow band for weeks. Do you get impatient and look away, or do you get interested and study it? That answer will tell you a lot about your mindset as a trader. The impatient eye sees boredom. The professional eye sees potential energy. That difference is what separates the losers from the winners. Inside that sideways band, important things are happening beneath the surface. Large operators are taking their positions. If they want to accumulate stock, they can't do it all at once. They buy in pieces, they absorb whatever supply the public offers. The chart looks flat, but the ownership is quietly shifting. Distribution works the same way. If big money wants to unload stock, they do it inside a range, selling into rallies, keeping the tape quiet so they don't spook the crowd. By the time the breakout or breakdown comes, the groundwork has already been laid. The professional has been watching, while the amateur has been sleeping. Volume tells the story if you know how to read it. In an accumulation phase, you'll notice volume picking up on rallies and drying up on declines. The stock doesn't fall much, even when the market is weak, because strong hands are supporting it. That's a clue. In distribution, the opposite happens. Rallies look weak, and selling pressure shows up on higher volume. The stock can't advance far before sellers step in. The tape looks flat to the untrained eye, but the professional can sense the battle beneath the surface. So when you hear someone dismiss a sideways market as dead money, you should smile. That so-called dead money is where the smart money positions itself. It's the soil from which the next big move grows. The amateur may think nothing is happening, but everything is happening, just not in a way he can see. By the time he notices, it's too late. The stock has already broken out, the trend is underway, and he's left chasing prices that are now dangerous to buy. Do you see the lesson here? It's not about finding excitement, it's about finding preparation. The sideways market is preparation in disguise. If you can learn to respect it, study it, and wait through it, you'll be the one holding stock when the real action begins. That's how fortunes are made, not by gambling inside the chop, but by being ready for the moment it resolves. Of course, there's a temptation to try to trade the range. Many traders tell themselves they'll buy at the bottom, sell at the top, over and over. On paper it looks simple. In reality, ranges are messy. They throw out false signals, shake out tight stops, and punish those who think they can outsmart the tape. The professional doesn't waste his capital on that game. He saves his bullets. He understands that sideways action is not there to be conquered. It's there to be studied. The money is not in scalping the noise, but in catching the move that comes after. Now let me ask you, how many times have you been chopped up in a sideways market, only to see the real breakout happen after you've given up? That's no accident. That's the market testing your patience. Most fail that test. The few who pass it are the ones who are rewarded. Sideways markets also serve another purpose. They filter out the crowd. The longer a stock drifts sideways, the more traders lose interest, the more volume dries up, the more public participation fades. By the time the breakout comes, only the strong hands remain. That's why the move can be so powerful. There's no one left to sell. Supply has been absorbed. Demand rushes in, and the stock explodes. The breeding ground has done its job. This is why professionals are willing to sit through what others call wasted time. They know it isn't wasted at all. They know sideways markets are necessary. They know nothing big can happen without them. And because they know this, they respect them. They use the time to prepare mentally, to sharpen their observation, to build conviction. When the tape finally shows its hand, they're ready to act, while everyone else is caught by surprise. So when you look at the market and see dullness, remember dullness is the mask that hides the birth of big moves. Don't be fooled by appearances. The breeding ground is always disguised as boredom. The man who trains himself to see beyond that will be the man who profits when the rest of the crowd is still yawning. Protecting capital in sideways markets is just as valuable as making profits in trends. That may sound like a defensive statement, almost unexciting compared to the idea of chasing a big winner, but it is one of the most important truths in speculation. Too many traders measure their success only in terms of money made. They rarely stop to consider the value of money saved. Yet in the long run, the capital you protect during the dead periods is what allows you to stay in the game long enough to participate in the big moves when they finally come. Most men who step into the market think their task is to be busy, always trading, always hunting profits. They imagine that capital sitting in cash is wasted capital, that the only way to justify their presence in the market is by being in a position. But the market does not reward activity for its own sake. The market rewards correct positioning at the correct time. And when the tape is sideways, there is no correct time. The price is undecided, the balance between supply and demand is equal, and no great fortune can be made in such conditions. The amateur insists on trying anyway, and that's how his account gets whittled away. Let me ask you this, how many times have you told yourself that you'll just take a small trade inside a range, just to stay active, and then watch that small trade turn into a string of small losses that add up to something painful? That's the tax the market collects from impatience. Every unnecessary entry, every attempt to outsmart the chop, is a withdrawal from your trading stake. The market doesn't have to deliver a big loss to ruin you. It can bleed you dry with 100 small cuts. Protecting your capital is the only antidote to that death by 1,000 paper wounds. Now, consider the mindset of the professional. He knows his capital is more than just money in an account. It is his ammunition, his lifeline, his license to operate in the game. Without capital, he is nothing. The market does not care how skilled you think you are if you have no stake left to press when the opportunity finally comes. That is why the professional guards his capital fiercely, especially in sideways stretches. He knows that sideways markets are where most traders destroy themselves, not because the market delivers great shocks, but because it lures them into wasting bullets. The professional is stingy with his bullets. He preserves them for when the odds are truly in his favor. Protecting capital in sideways markets is not passive. It requires active discipline. It means saying no to the itch for action. It means accepting boredom. It means watching the tape without needing to trade it. That may not sound glamorous, but it is far harder than it seems. The crowd always wants to act. The ticker invites them. Every little tick up or down whispers, something is happening, don't miss it. The professional knows better. He reminds himself that nothing meaningful is happening until the balance of power tips decisively. Until then, his job is not to trade, but to observe and preserve. Wealth in trading is built by compounding. Every time you protect your capital, you are protecting the base from which future gains will compound. If you lose chunks of that base in sideways chop, you cripple the power of compounding before it can even begin. Think of it this way. A soldier doesn't waste ammunition firing blindly into the night. He conserves it for when the enemy shows himself. A trader who throws away capital in sideways markets is like a soldier emptying his magazine at shadows. When the real battle begins, he has nothing left. Which role do you want to play? I can tell you from my own experience that some of my best months as a trader weren't the months I made the most money. They were the months I lost the least. Surviving through dull, choppy markets without damage set me up to participate when the next big trend arrived. My capital was intact, my mind was clear, and my confidence was unbroken. That made all the difference. Many others around me had bled themselves during the dull phases and were either too demoralized or too underfunded to catch the real move. The market doesn't just reward intelligence, it rewards endurance. It is easy to be tempted into thinking that small trades inside ranges can keep you sharp. But ask yourself, does sharpness come from constant action, or does it come from disciplined observation? The truth is, every bad habit you build in sideways markets, overtrading, ignoring risk, chasing noise, will bleed into your behavior when the real opportunities come. You won't suddenly become disciplined when a breakout arrives if you've spent weeks practicing recklessness. Protecting your capital also means protecting your discipline. It means keeping your trading habits aligned with professionalism, even when you're not pulling the trigger. The professional understands that cash is not wasted capital. Cash is a position. In sideways markets, it is often the best position. It gives you flexibility. It preserves your energy. It ensures that when the coil finally snaps and the tape chooses its direction, you can enter with strength. The amateur sneers at cash because he confuses inactivity with weakness. The professional respects cash because he knows inactivity is sometimes the strongest action of all. Have you noticed how the public behaves when a market finally breaks out of a long range? They are caught unprepared. They have been chopped to pieces. They no longer believe a big move is possible, or they've been shaken out so many times that they hesitate to enter. Their capital is damaged, their confidence is gone, and their timing is wrecked. That is the cost of failing to protect capital in sideways periods. The professional, meanwhile, who resisted the urge to gamble, has his funds intact. He can act swiftly with conviction and ride the new trend. Protecting his stake during the dull days has set him up to prosper during the exciting days. Every great fortune in speculation is tied to this simple principle. You must live to fight another day. Capital protection is survival, and survival is victory. The sideways market is not your enemy if you know how to treat it. It is the training ground for patience, the proving ground for discipline, and the safeguard of your ammunition. To the untrained, it looks like dead time. To the professional, it is the time when he ensures his readiness for the real campaign ahead. Let me put it to you directly. Would you rather waste your powder firing at shadows, or would you rather wait for the target to stand in the open and then strike with certainty? That's the difference between losing money in sideways chop and protecting it until the market offers you a clear chance. One approach drains you, the other prepares you, and only one of those approaches leads to lasting wealth. Patience is a position. Staying flat is often the strongest trade. Most men who step into the market don't understand that. They believe the only way to be a trader is to always hold something, long or short. They feel naked if they are flat. They think being in cash means being out of the game. But cash is not weakness, it's power. Flat is not indecision, it's discipline. In fact, when the market is moving sideways, when the tape offers no real direction, staying flat is often the only professional move you can make. Let me ask you this. How many times have you forced a trade just because you couldn't stand the idea of sitting still? You felt the itch, you wanted action, so you put money on the line, even though deep down you knew there was no clear signal. And what happened? More often than not, you took a small loss, then another, then another. Before long, your account was lighter, your confidence shaken, and your patience destroyed. All because you couldn't recognize that waiting is a trade in itself. The amateur equates patience with inactivity and inactivity with failure. He thinks he must always be involved, always prove his skill by being in the market. He doesn't see that patience is the real skill, the real sign of strength. The professional knows that he is not being paid to trade every day. He is being paid to wait for the right time to trade. The market is not a factory where you punch a clock and collect wages. The market is a battlefield, and you don't charge forward every moment. You wait until the odds tilt in your favor. There is a saying that markets take money from the impatient and give it to the patient. That's not just a clever phrase, it's reality. Sideways markets exist to test your patience. They grind back and forth, just enough to tempt you, just enough to shake you, just enough to make you act when you should be sitting. The impatient fall into the trap. The patient preserve themselves.